In today's yield-parched financial landscape, YieldMax ETFs have emerged as intriguing contenders for income-hungry investors. These exchange-traded funds leverage a unique covered call strategy on popular technology stocks, aiming to deliver enhanced yield streams while retaining exposure to potential capital appreciation. But beneath the alluring headline lies a complex tapestry of opportunities and potential pitfalls. Let's unravel this intricate strategy, dissecting its mechanics, merits, and limitations to determine if YieldMax ETFs deserve a place in your portfolio. Peeling back the layers, the mechanics of YieldMax ETFs. At the heart of YieldMax ETFs lies a marriage of two seemingly disparate financial instruments: high-growth technology stocks and covered calls. The fund holds a basket of these tech titans, akin to Apple, AAPL, Tesla, TSLA, and NVIDIA, while simultaneously selling covered calls on those same stocks. These options grant the buyer the right, but not the obligation, to purchase the underlying shares at a predetermined price, strike price, by a specific date, expiration. In return for granting this right, the ETF receives an immediate premium, bolstering its overall income. Unlocking the advantages: why YieldMax ETFs entice investors. The appeal of YieldMax ETFs hinges on a trifecta of potential benefits. Supercharged yields. Compared to traditional dividend-paying stocks or ETFs, YieldMax often boasts significantly higher annualized yields, often exceeding 4%. This makes them a siren song for income-focused investors seeking to turbocharge their portfolios with consistent cash flow. Dual engine of growth. Beyond the immediate income boost, YieldMax ETFs retain the underlying technology stocks. This grants exposure to the long-term growth potential of these innovation powerhouses, potentially amplifying overall returns through capital appreciation. Hedging grace. The covered calls act as a form of downside protection. If the stock price dips, the calls may not be exercised, potentially mitigating losses. This offers a valuable safety net, particularly for investors seeking a balance between income generation and capital preservation. However, the path to high yields is not always paved with smooth asphalt. YieldMax ETFs come with their own set of challenges. Capped upside potential. Remember those covered calls? They act like a ceiling on potential gains. If the stock price soars past the strike price, the ETF forfeits the opportunity for unlimited upside. This can significantly limit overall returns during periods of exuberant market rallies. Early assignment blues. Call buyers hold the cards, and they can choose to exercise their options before the expiration date. This forces the ETF to prematurely sell its holdings, potentially locking in losses if the stock price has fallen. Fee fiesta. Compared to their passive brethren, YieldMax ETFs often carry higher expense ratios. The active management involved in selecting and managing the covered calls comes at a cost, potentially eating into your returns. While YieldMax ETFs offer an intriguing income-generating proposition, they are not a one-size-fits-all solution. They are most suitable for investors who prioritize income, individuals seeking regular cash flow to supplement their retirement income or other financial goals can potentially benefit from the consistent payouts generated by these funds. Possess risk tolerance. Understanding and accepting the inherent risks, such as capped upside and early assignment, is crucial before diving into YieldMax ETFs. Embrace active strategies. Investors comfortable with option strategies may appreciate the active management and the potential for income enhancement, even in sideways markets. Beyond YieldMax, weighing alternative income options. YieldMax ETFs are not the only players in the income game. It's crucial to compare them to other contenders. Dividend ETFs. While offering lower yields, dividend ETFs generally provide more predictable payouts and less exposure to option-related risks. Individual covered call strategies. Seasoned investors with the requisite knowledge and resources can implement their own covered call strategies, potentially customizing the options used and potentially incurring lower fees. YieldMax ETFs present a compelling option for income-focused investors, particularly those seeking high yields from the burgeoning technology sector. However, they are not without their wrinkles. A thorough understanding of the risks and limitations, coupled with a consideration of alternative income options, is essential before making any investment decisions. Remember, responsible investing demands diversification and a clear-eyed assessment of both the potential rewards and the lurking risks. Delving deeper into YieldMax ETFs, a practical guide for income investors. Let's shift gears from the theoretical to the practical. Now that we've grasped the core principles of YieldMax ETFs, let's explore how to navigate these funds through real-world examples and actionable advice. Here's how to make informed decisions about YieldMax ETFs within your portfolio. Picking the right YieldMax ETF. The YieldMax family boasts a diverse array of funds, each with its own unique flavor. Here are some key factors to consider when choosing the right one for you. Underlying holdings. Identify the specific technology stocks the ETF holds. Do they align with your investment thesis and risk tolerance? Some focus on established giants like Microsoft and Alphabet, while others lean towards more high-growth, high-volatility players like Tesla and Rivian. Yield target. Consider your desired income level. While all YieldMax ETFs aim for enhanced yields, their actual percentages vary based on the chosen option strategy and market conditions. Compare yields alongside fees to ensure sustainable income generation. Expense ratio. As mentioned earlier, fees can chip away at your returns. Opt for funds with lower expense ratios, ideally below 1%, to maximize your income stream. Let's put theory into practice. Consider two popular YieldMax ETFs. YYLD, YieldMax Enhanced Technology Dividend ETF. YYLD focuses on established blue-chip tech companies like Apple, Microsoft, and Amazon. It boasts a relatively moderate yield of around 5% and charges a 0.95% expense ratio. This option might be suitable for income-seeking investors with lower risk tolerance. TSLY, Technology Select Covered Call ETF. TSLY leans towards growthier tech stocks like Nvidia, Tesla, and PayPal. It offers a higher potential yield of around 8%, but carries a higher expense ratio of 1.25%. TSLY could be an option for investors comfortable with higher volatility in exchange for potentially higher income. Remember, YieldMax ETFs are most effective as part of a diversified portfolio. Here are some additional tips. Monitor underlying stocks. Actively track the performance of the underlying stocks within your chosen ETF. If a stock's price falls significantly, consider diversifying or exiting the ETF to mitigate potential losses. Reinvesting dividends. Consider reinvesting the received dividends to benefit from compounding and potentially boost your long-term income stream. Tax implications. Understand the tax implications of covered calls and option premiums. Consult a financial advisor for specific guidance on how these factors might affect your overall returns. Beyond YieldMax, alternative income strategies. While YieldMax ETFs offer a unique approach, don't forget to explore other income-generating avenues. High-dividend stocks. Research individual companies with established track records of consistent dividend payments. Diversify across different sectors to mitigate risk. Real estate investment trusts. REITs own and operate income-producing properties, typically offering attractive dividend yields. Consider both equity and mortgage REITs to diversify your income sources. Bond ETFs. While offering lower immediate returns compared to YieldMax ETFs, bond ETFs provide steady income streams and can act as a ballast during market downturns. The final word. YieldMax ETFs present a compelling option for income-hungry investors, but they demand careful consideration. By understanding their mechanics, assessing risks, and comparing them to alternative income vehicles, you can make informed decisions about whether these funds deserve a place in your portfolio. Remember, responsible investing is about aligning your financial goals with a suitable strategy, one that generates consistent income while protecting your hard-earned capital. So, delve deep, ask questions, and confidently step into the world of YieldMax ETFs, but always with a healthy dose of due diligence and diversification.